Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
The Boy Scout marching song. The Boy Scout motto is be prepared. I was an Eagle Scout. I remember those days. Be prepared. It was the Boy Scout marching song. It was the Boy Scout motto. Be prepared. It's not only good for the Boy Scouts, but it's even more important for investments. And that's the theme for today, to be prepared. That's the focus of this program, is that you should be ahead of the curve instead of behind the curve. You should be preparing for what's coming, not for what's been. Be prepared. And what's the point of the whole thing? For some, it's going to be prepared for the worst and hope for the best. For others, today's program is going to be prepared for a long overdue need for change. And I'm somewhere in between. I'm not expecting terrible things. I'm not expecting great things. Somewhere in between. But I do believe it's a time to be prepared. And the point of all this is Elizabeth Warren. You know, it's possible she loses the nomination. It's possible the Senate majority remains Republican. It's possible the Republicans retake the House, and it's possible that Trump's reelected. And that's one extreme. The other extreme is that she gets the Democratic nomination, that she is elected president, that the Senate swings to a majority of Democrats, and the House remains majority Democrat. Two opposite extremes. And the probability is it will probably be somewhere in between those. But whatever it is, even if she doesn't receive the Democratic nomination, with what she's proposed, it's going to be a dramatic change coming up, or dramatic proposals coming up. And so now is the time to begin to prepare for it. Doesn't mean they're going to be enacted, doesn't mean that it's going to happen. Even if you take something as radical, and we're going to talk about it more in detail, take something as radical as Medicare for all, Medicaid for all. Even with that proposal, if that goes, if she's elected, if the Democrats control the Congress, if she's elected president, even going through that process, you know how it works. There isn't just because she would be president that it will happen, because it has to go through Congress, and it's going to be compromises that are made. And it will not be the exact same thing as she proposes, almost for sure. You can count on that. But regardless of that, the question is, what does she propose? And I'll give you some of my thoughts, and I'll give you some of my thoughts on some of the good things that she proposes and some of the things that aren't so good. And I believe there are some that are good. In what she's proposed, essentially she's talking about remaking American capitalism. Remaking it in such a way that we haven't seen it since in my lifetime. But we're talking about the same kind of makeover as happened in the 1930s when Franklin Delano Roosevelt was elected president. And her goal really is there, to remake American capitalism. And it sounds bad in a lot of ways, but some of the changes may be good. When you look back historically, if you look back at American capitalism at the turn of the 19th to 20th century, back in 1900, if you've read the book The Jungle by Sinclair Lewis and saw the abuses that were taking place, the abuses of the workers, you know, when you read the book The Jungle, if you read the book Jungle, you know somebody fell into the grinders for the meat, and they were just ground up and made into hamburger. I mean, those were the kind of things that went on in the 1900s, in the 1910s, 1920s. There needed to be a reform, in my opinion. If you read Ida Tarbell's History of the Standard Oil Company. There were tremendous abuses and a destruction of the competitiveness because of the Standard Oil Company. I don't know. Ida Tarbell, we did read it. It was, I think, 6 volumes, maybe 2,000 pages, maybe 2,400 pages. History of what went on with the Standard Oil Company. Those were abuses that were taking place through the late 1800s into the 1900s. It was an abuse of the poor and the working people. So the question is whether enough abuse exists today. And maybe it does, maybe not. If you look at where we are, the United States has a higher income inequality than any other rich country. The top 0.1% of Americans own 21% of the country's wealth. Think about that. The top 0.1. That's 1 out of 1,000 owns 21% of the country's wealth. The bottom 90% own about the same amount. So there's a tremendous income gap. And when you compare how incomes have changed since the late 1970s to today, the top 0.1%, the top 1% have had an increase of almost 250%, whereas the bottom quartile has had an increase of less than 50%. So there's issues that are going on. And Warren's plan is a wealth tax. It's to focus on the ultra-high net worth. Very similar. What it is very similar to a property tax. You get your bill in the mail if you own property, if you own a house. You get a bill in the mail that says this is what the auditor thinks it's worth, and this is the percentage that's applied, and this is what's owned. The difference with the wealth tax is it's not just real estate, it's the entire amount of wealth. And it's a tax that's just focused on those people that have $50 million or more. It's a focus of the ultra high net worth individuals. And it's becoming very, very controversial. If you listen to CNBC or you look at some of the magazines that are coming out, some of the articles, some of the broadcast networks, you're seeing a lot of ultra high net worth people coming and talking about the impact that it's going to be. The ultra high net worth people, they spend 40% of the money that goes. The 1/10 of the population, 1/10 of 1% sends 40% of the money for political campaigns. They're very, very wise in using their money in some ways, very powerful in using their money to influence what governments do. So it's becoming very controversial. They talk about what's happening, and they talk about it, and they put a spin on it in saying 12 other nations have installed a wealth tax, but of the 12, 9 dropped it. But you have to look beyond just the fact that 12 put into effect a wealth tax and 9 have dropped it. You have to ask why. And there were 2 things that happened in those nations who dropped the wealth tax. One was the loopholes, and secondly, it's very easy to move to another country in the European Union. So Warren deals with both. The idea, or what happened with the wealth tax in those countries that gave it up, is that the wealthy pushed politicians to pass one loophole after another, until essentially you had a wealth tax which was very, very limited in nature. That Warren addresses by saying there will be no exemptions. You just take your wealth and you apply 2% or 3% of your wealth, and you pay that every year. And for those people who move from one country to another to avoid paying the wealth tax, Warren says there'll be a 50% penalty on your wealth if you move and give up your U.S. citizenship. So it's not made Wall Street very happy. It's not made the bankers very happy. There are predictions now that if she's elected president and institutes a wealth tax, the market will drop 25%. The fact is that markets are driven by profits, and taxing Bezos 7%, or Gates 7%, or Buffett 7%, or even, and they're only talking 3%, but it's not going to change the homeowners who are buying gas, the homeowners who are going out to restaurants. It's not going to affect a significant portion of the population. 70% of our GDP is consumer products, consumption. And that's not going to change by taxing wealth. It's not going to keep people from going to restaurants. It's not going to keep people from taking vacations. It's not going to keep people from buying furniture or the many other things. It's not going to keep them from reading books. It's not going to keep them from going to movies. The fact is, we're not going to see a 25% drop. It's not going to keep you and me from going to the doctor. It is, on the other hand, going to have a significant positive effect, I think, on the economy. More about that when we come back. Don't go away. We've got a lot more to cover. Be right back after the break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about Elizabeth Warren and her proposals. Whether she's elected or not elected, whether she gets the nomination or doesn't get the nomination, it's a very strong possibility that some of her ideas, some of her programs will be discussed and may be implemented. And so the idea is to prepare and be prepared for what happens if they do happen. And to understand the impact on the economy, to understand the impact on investments. There's not enough time to cover all of her proposals, so I only want to talk about three. I talked about the wealth tax. I think it's a positive thing because it is something that will put money and fund the programs she's talking about implementing. Those are positive programs. Those are going to pump money into the economy. And by the time the butcher pays the baker pays the candlestick maker, you have a multiplier effect. It's not going to be just the 2% or 3% that she's proposing in terms of the wealth tax. By the time you come through, it's going to have multiplied and be a positive for the economy. For those who say the stock market's going to drop 25%, I don't think so. I really don't think so. I think it's going to be a positive impact. And I could be completely wrong. But the second point is she is going to go after private equity and big companies. Currently, private equity pays only 23.8% on their earnings. That's 2/3 of what I paid last year. And if you look at the deals that they do, TXU was an energy company. In 2007, they purchased, a group of private equity firms purchased TXU for $45 billion, and they borrowed $40 billion to do that. The bet was that natural gas prices would rise, and if they didn't rise, the bondholders would be the ones that got stuck. In 2014, sure enough, the bondholders lost everything because TXU filed for bankruptcy. And maybe the bondholders didn't lose everything, but they lost most of it. Goldman Sachs used to be a partnership, and they were a major player in this whole deal. Goldman Sachs. Goldman, when they were a partnership, if Goldman Sachs in their trading had a loss, the partners had to divvy it up out of their own pockets. Works the same way as my business. If Adams Financial Concepts has a loss, I pony up the loss out of my pocket. If you're a business owner, you know how that works. If you have a loss, it comes out of your pocket. But now, Goldman Sachs is a public company. They have shareholders. So if they have a loss, it comes out of the shareholders, not out of the management, not out of the partners. It doesn't come out of them at all. It comes out of the shareholders. So in terms of what happened with TXU, Goldman put up 10% and borrowed 90%. And it was the bondholders that lost most. Now, under Elizabeth Warren's proposal, if they do a bad deal, it's the owners who take the loss, the private equity firms that take the loss, not so much the bondholders. How would that work? It's not going to be easy to make that work. But yet, it's probably going to be a positive in fewer deals getting done, fewer bad deals getting done. Where's the responsibility? I mean, Goldman Sachs is also the company that sold a lot of those bonds. Where's the responsibility that they have to the bondholders to make the bondholders correct? I have stories I can talk about bondholders and some of the things that I've gone through. But I think that's a significant thing that's got to be dealt with. What happens with private equity? They don't pay much in taxes, and if there's a loss, they pass that loss on to bondholders or to others. Somewhere there has to be a greater sharing of a loss. I think if whether Warren gets elected or not elected, we're going to start to see some of that dealt with. Glass-Steagall is part of that whole deal. Banking and brokerages up until 1999, from the 1930s until 1999, the Glass-Steagall Act was in effect, and what that did is it separated banking and brokerage account firms. And there's two different cultures. In a bank, you never get in trouble for a loan you don't make, because the loan will never go back because you never made the loan. In brokerage houses, unless you invest, you don't make any money. Now, the banks have a lot of assets, and they don't make very much on those assets. Brokerage firms have very few assets, but they make a lot of money when they make money on those assets. So by combining the two, we're moved back into where we were in the 1920s with the banks and brokerage firms. And during the Dodd-Frank, they added the Volcker rule, which would have limited the amount of speculation banks can do. Banks can speculate with a whole lot of customers' assets, and that just isn't right. I'm okay if they keep the Volcker rule, but I'm not so sure that they're going to keep the Volcker rule. And Glass-Steagall made sense in the 1930s and 40s, 1950s, 1980s. I think it still makes sense. I think it's a positive. I think it keeps the banking system sound and safe, and that's a positive for the economy. That's my opinion. The other thing is that Warren wants to break up the large companies, and she wants to break up the banks. You know, if you look at where we are today, we have large companies making record profits, and wages have been relatively stable. That's not usual. And the argument can be made that because the corporations have become so big that they've limited competition, they're wiping out the competition, so they're able to have absolute price control or a lot of price control without having to compete on the basis of what they provide. You know, that's the position that Warren's taken. There's some truth to that. There's some that's not so true. The question is, how do you break up the big companies? And in my opinion, there's two big issues with that. One is, by breaking up the companies, you are preserving and protecting old technology. There's a number of companies that acquire smaller companies with newer technology because the old technology is fading away. But if you cause those companies to break up, you're protecting the old technology at the expense of driving new technology. Secondly, she wants to designate some large companies and regulate like utilities. Companies like Facebook and Amazon and Apple. Take Apple, for example. it's not quite as close to home as is Amazon. So Facebook has their iPhone and their iPads, and they have a number of apps that run on those. Facebook or Apple can pick and choose and push their own apps versus those that are independently written. For Warren, for a number of academics, that means they're limiting the competition. They have the ability to limit competition. So Warren's proposal is that they become a platform company where they have control of their hardware and the software to run it, but they don't have control of the apps. The same for Amazon. Amazon not only is able to market, but they also control some of the products they market. And Facebook. Facebook has WhatsApp, bought WhatsApp at an enormous price. They bought Instagram, all that to limit competition. We went through that with Microsoft in the 1990s. And, there's a way in which to do that. It's easier said than done. And the question is, what are the unintended consequences of doing that? Plus, in addition to those things, she's proposed that large companies have charters, and those charters can be revoked by state attorney generals. State attorney generals can ask that a company's charter be revoked and put them out of business. Think about an administration that's vindictive, that gets upset with a company and puts them out of business. That just doesn't fly for me. That just doesn't make real sense. I understand the whole process of large companies and limiting competition, but that proposal just doesn't make sense to me. It's one to be prepared for. Finally, she's talking about having boards that have 40% of the board from employees of the company, lower level employees. So if 40% of the S&P 500 companies' revenues are coming from overseas, how do you put that on? Do you have to have a Spaniard on your board? Do you have to? How does that all work? Anyway, there's a lot of issues going on. The whole purpose of this whole thing to talk about is there will be some of these proposals that make it forward. And some of these things you're going to be hearing about in 2021. No matter if she gets the nomination or not, no matter if she's elected or not, no matter if she's just a senator, there are proposals out there. And these proposals are concrete proposals, and they're getting some traction. 40% of the people in the polls like what she's saying. That means there's going to be some of this coming up. Now is the time to think about it. The purpose of this program is to put you ahead of the curve, and truly that's the purpose of today's program. Be prepared. For my clients, I began to make some changes over 6 months ago. Not huge changes, but it's a constant time of evaluation and assessment. And that's what I recommend that you do as well. These are trying times. These are times in which we could be changing. We could see the remaking of the American capitalism. So be prepared. There'll still be opportunities. We're here because I have a passion to create wealth. That's what it's about. Coming up, I've got a guest today you want to hear because we'll deal with some of the issues and the safety net. So don't go away. Be right back after this commercial break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So we're going to change direction now. I've been talking about Elizabeth Warren. She has so many proposals out. It's hard to cover even a tiny fraction of what she's talking about in a program, a 1-hour program, and I tried to do it in just the first half hour. So it's something to pay attention to think about. Be prepared. That's not just the Boy Scouts motto. It's really something for investments. We'll be talking more about that as the year goes along because we've got a ways to go until 2021, and who knows where we'll end up with the whole thing. So stay tuned. We've got more to come as we go along. But right now I want to shift, and I want to introduce Jim Wigfall of Sound Generations. Welcome to the program, Jim.
Thank you.
So why don't we start with your background?
Let's see. Okay, so I actually worked 32 years for the Boeing Company, held various positions there, retired at the end of 2017 as the vice president responsible for all of the facility support to Boeing commercial airplanes.
So that's quite an experience.
Yes, definitely. And from there, actually really wasn't quite ready to retire, and was looking at some of the challenges my aging parents were having and saw this opportunity to lead Sound Generations and put my name in the hat and was selected to be the CEO of Sound Generations.
Well, congratulations. So let's talk about Sound Generations.
Definitely. And so at Sound Generations, we support people on their aging journey through our community connections and our accessible services. We have 4 pillars of the services we provide. We have food security, so that's things like Meals on Wheels and community dining, where we actually provide a hot lunch at 21 different sites Monday through Friday throughout King County. We have transportation, where we have what we call volunteer transportation, where we actually have volunteers in the community that will take individuals to medical appointments. And we also have what we call the Hyde Shuttle, where we have 21 different routes throughout King County, where we have it's a 21-foot passenger accessible van that takes individuals to the library, to a senior center, shopping, whatever, but provides 41 different routes throughout King County so individuals can get around. We also have a health and wellness, where we have Hands Fitness, Hands Wellness, where anywhere from chair aerobics to full-on aerobics to matter of balance to eating nutritionally, things of that nature. And we also have assistance services, and so there we do minor home repair, we have caregiver support, we have our pathways and assistance, we have our statewide health insurance benefits advisors providing information on Medicare and Medicaid, and we also provide legal assistance to individuals, so quite a wide variety of services that we provide to the community.
So let's start way back at the beginning. You talked about Meals on Wheels, and it's a program. Tell us a little bit about that.
Yeah, so Meals on Wheels, it's and actually it's more than just a meal. So Meals on Wheels, we provide meals to individuals, to a lot of people that are homebound that can't get out and get meals. We also enable them to avoid isolation by actually having with the people that deliver the meals to be able to interact with them, see how they're doing, see if they're taking their meds and everything, and being able to interact with them as we deliver meals. But we provide meals from anywhere from kosher meals to halal meals, quite a wide variety of different meals that we provide to be able to meet their nutritional value. And we actually have a dietitian that does nutritional analysis to making sure that they are actually eating nutritionally.
So when you talk about meals, how many meals per week are they allowed?
Up to 14 a week. So they can order it, and we'll deliver it to them. And we deliver them frozen, so then they'll be able to heat them up when they're ready.
So that raises a question. What happens if they deliver meals to someone and find out the electricity has been shut off? Because we're dealing with a part of the population where income resources are very limited.
Yes, exactly. And that's why I began saying it's more than just a meal. And so as we deliver the meals, if we realize that their electricity's out, we'll make the connection to our Pathways and Information team so that they can actually work with individuals to get the service that they need provided to them.
So you help in terms if the electricity is turned off, you help resolve that issue.
Right.
So what about somebody that's having a medical problem?
Yeah, and so so if someone's saying, we realize that they're not taking their meds or something like that, or if they've fallen and they can't get up, those types of things. And so then by having the individual come to deliver the meal, they're able to interact, find out what's going on, and once again to get them connected to the right service in the community.
So you also talked about the shuttle that will take them to different places. Mm-hmm. I mean, one of the issues, the two big issues, once somebody retires, the two expenses that significantly increase are medical expenses and transportation. And it seems with the cost of transportation, for those who have limited incomes, it's a difficult thing for them to get around. And yet, to be homebound, to be housebound, is a bad situation as well.
Exactly.
So talk about the transportation and what happens there.
Yes, and there we're able to have the individuals contact us so that they can reserve their ride, and we either have, so if they're going to a medical appointment, then we actually have our volunteers that will actually pick them up and take them to the appointment and actually wait for them while they're at the appointment, and then to take them back home. And so being able to provide that service, but then also some of the individuals are a little bit more mobile and they can get around, and they'll want to go to a community center, they'll want to go to the library, they'll want to do something, and so they'll make a reservation with us, and we'll pick them up and take them there and let them engage with what they're doing, and then take them home.
So one of the aspects as you grow old, there's the intergenerational question, because there's a positive, studies have shown there's a positive impact when you deal with younger and older people. How is that being addressed?
Yes, agree with you 100%, because we want to encourage multi-generational engagement. It helps everyone on both ends. And we do things like some of our senior centers, we have a Rainbow Bingo. And actually it's individuals that are there participating from all age demographics, enjoying, having a good time. But then we also, so actually just working with our Shoreline Lake Forest Park Senior Center, working there to put together a proposition that hopefully gets passed with this latest election. They're going to be to put in a new community center, and in their community center there'll be 6,000 square feet of space for senior programming. And so then there you'll have a community center that engages all generations. So trying to do more and more to get intergenerational engagement.
So then I have a question also as well, because when you walk around Seattle and areas outside of Seattle, everywhere you look, you see help wanted signs. So what about volunteers? Do you have an issue with getting volunteers to do the work?
No, actually, volunteers they're a mainstay of our organization. We have over 2,500 volunteers that are working with us on an annual basis, and we love to get people engaged in helping us make a difference. And there's a wide variety of things people do. I mentioned the volunteer transportation that they provide. Other things like with our Meals on Wheels. We have, so if you've ever driven in Seattle, it's not the easiest place to get around. And so our drivers will only be able to pull up to the curb, and they can't actually have the time to get out. So we have a volunteer that'll get out of the vehicle and deliver the meal and be able to engage with the client and everything. So there's quite a few volunteer opportunities for us.
So, there's a cost to all this. And you do a gala every year.
Yes, we do, and so yes, there is a cost, and so we try to raise money to be able to deliver our services. And so actually, the last Saturday of September, we have our annual gala, and this year the theme was the Roaring 20s, and so people came engaged. I had my white brim hat on and my white tie with my black suit and things like that to have a little fun while we raise money to be able to make a difference for aging adults and adults with disabilities.
So tell the listeners where they could find out information on the gala and how they might get involved in this?
Yes, so you can just go out to our website at soundgenerations.org and find out about all the volunteer opportunities that you can get engaged with. We have actually a luncheon in the summer, and then also our gala in the fall. And you can come and help and you can volunteer at those events and help us to make a difference in the community.
And come to the gala. You have a silent auction and a live auction, right?
Yes, exactly.
And great prizes. So some of the listeners could donate things for the auctions as well, right?
Oh, definitely. We definitely encourage that.
And if they have ideas to donate, who would they contact?
And they reach out to myself, Brittany Blue, our philanthropy leader, to just go out to our website. You'll see all of our contact information there, and we'll be glad to help you.
The website again, Tyler?
Is soundgenerations.org.
That's great. Thanks for being on. It's really important. You know, when you consider that about half the people in this country are retiring on Social Security and a limited Social Security, programs like this are crucial and very beneficial to all of us. So if you can get involved, get involved. We'll be coming back right after this commercial break. Don't go away.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Okay, so the latest fad in investing. And we go through these fads. We go through these different times of having certain things where they're in fashion and out of fashion. But the latest investing fad now is called factor investing. Academics have identified 5 genuine factors. One of those factors is value. You look at stocks that are value. Quality. You look at stocks that are quality. The third factor is momentum. The fourth factor is small cap stocks or a certain size, large cap, medium cap. And finally, you have a factor of minimum volatility. And if you think about how all this operates, if you think of a line with all these different fads or different ways of investing on the line, at one end of the line, say it's the left-hand side of the line. At that side of the line, you have index funds. And that's a type of investing. A lot of people are doing index funds. Index funds now have more assets. There are more assets in index funds than there are in actively managed funds. So at the far end, you have index funds. And then as you move a little further along, you have factor investing. As you move toward the right, you had index funds, and then the next thing you have is factor investing. And then if you move a little further to the right, you have quant methodology. That's computer algorithms. Computer algorithms are making 60% or so of the trades that are made in the market today. Type of investing. They make a lot of trades, but they make them in very small increments. They're looking for pennies, or they're looking for fractions of a penny on arbitrage, some of those computer algorithms. But they do a lot of trades, but they're coming after factor investing. And then if you move to the right side of investing, you have active investing. That's where I am, at the very right-hand side. And I think I said the line the wrong way. It's the left hand, where I should have said were index funds, and then as you move to the right. Should have said that's my other right. Anyway, so at the left-hand side, you have index funds. Then you move into factor investing. Then you have the quant methodology, the computer algorithms, and finally you have active investing. And factor investing focuses on various rules-based methodology into various sectors. So you find a certain sector and and you set up a set of rules on what percentage of this factor to invest in, and you move things around in that way. So the question is, how is it really working? There's a strong belief right now, wherever you go in my industry, almost any conference you go to, people are talking about smart beta, they're talking about factor investing. They're talking about it generating superior returns. The facts are a little different. AQR Capital Management, one of the thought leaders in the industry, Cliff Asness, is a person who analyzes all these different factors, analyzes all the different investment philosophies that are being done, and his comments at every one of the conferences is exactly the same. Nothing is working. Nothing is working. Factor of investing is a top-down approach. It's a top-down approach. As index funds mean there's no real input in, you just try to structure an index around a certain segment of the stock market, whether it be the Standard & Poor's or whether it be biotech or whether it be something else. It's a non-decision type kind of investing. Factor investing is rules-based. Quantum investing means the computers make all the decisions. Humans don't do anything. But nothing seems to be working. It's a top-down approach. I've seen that happening when I left Wachovia way back in the day. They were focusing on sector investing, similar to factor investing, but factor investing, it's a top-down approach. I, on the other hand, am bottoms up. So what does that mean? I think when you look at bottom-up approach to investing, you look to get an example, and I use examples sometimes. So I use an example going way back. It's a matter of picking the right company. In an industry, companies have different expectations and different growth patterns. If you look at the early 1950s, for example, the biggest grocery chain was Great Atlantic and Pacific Tea, the A&P grocery chain. They were the largest retailing organization in the world. They were second only to General Motors in annual sales. Second only to General Motors. Their GDP was bigger than most, or their revenues were bigger than most countries' GDP. That's where they stood in the early 1950s. You had another grocery chain, Kroger's. They were half the size of A&P. They were not very distinguished in what they were doing. But early in the 60s, they began to set a foundation for transition to what they're doing. And it became market critical. And if you look at the next 25 years, from the early 60s to the end of the 80s, 25 years, what happened is that Kroger's stock increased 10 times more than the Dow Jones Industrial Average increased. 10 times. Not just a double, but 10 times what the Dow increased. And that was during the time in which the market did very, very well. And if you compare A&P and Kroger's stock outperformed A&P 80 to 1. For every dollar that A&P had increased, Kroger's increased $80. Think about that. Both were grocery store chains, both dealing in the same market. But picking A&P instead of Kroger's would have left you behind the eight ball. Same thing, Adressograph and Pitney Bowes. Both were almost perfectly matched. Revenues and profits, employees, stock charts, they were both almost nearly monopolies in the 1973. Pitney Bowes was doing postage meters. Adressograph was in address duplicating machines. Both faced losing monopolies. But by 2000, 27 years later, Pitney Bowes had 30,000 employees. revenues of $4 billion, addressable graph had 670 employees and revenues of less than $100 million. You know, the results in 27 years, Pitney Bowes stock grew 3,581 times over. Now, if you look at the stock today, nobody buys postage meters because technology has come along. But those 2 points illustrate a bottoms-up approach versus top-down. When we talk about factor investing, when we talk about index funds, when we talk about sector funds, what we're talking about is a top-down approach. I believe in order to really make money in the stock market, it has to be a bottoms-up approach. If you look at Buffett, bottoms up. Lynch, bottoms up. Fisher, bottoms up. Price, bottoms up. Templeton, bottoms up. Those were the great investors of the 70s, 80s, and 90s. I believe that's the way it has to be. Anyway, that wraps up the program for today. Have a great week, and if it's Saturday, I will be talking about Monday. Join me next Saturday.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts, 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 by Adams Financial Concepts.